Throughout the 20th century, Johnson & Johnson became a massive healthcare conglomerate with a leading portfolio of drugs and consumer brands, like Johnson's baby products and Tylenol painkillers. However, in 2023, J&J decided to spin off these consumer products to focus entirely on the pharmaceutical and medical devices divisions. What has led the healthcare giant to divest a cash cow with such iconic brands? And will this new structure provide sufficient support to grow its portfolio of experimental drugs? Welcome to Stocks Explained, your trusted guide to informed investing. As one of the leaders in the healthcare industry, J&J is actively involved in research, development, manufacturing, and sales of healthcare products. The company operates within the pharmaceutical and medical devices sectors, having recently divested and listed its consumer health segment on the New York Stock Exchange. J&J only maintains a 9% ownership interest in the newly formed entity known as Kenvue. This firm, which previously constituted a quarter of J&J's sales, boasts a diverse portfolio featuring over-the-counter medications and renowned brands such as Johnson's baby products, Tylenol painkillers, and Neutrogena skincare items. But why has J&J divested a cash cow with such iconic brands? As J&J evolved, analysts pointed out the consumer goods and healthcare segments have grown apart to have very different business models. For the consumer health market, approaches must be narrative-led, with brands crafting convincing stories to capture consumers' attention and reinforce their buying decisions. In the case of pharmaceutical companies, their aim is to convince healthcare professionals of the superiority of their product through data and scientific evidence, requiring a product-led approach. Furthermore, J&J's decision to spin off its consumer health segment comes in response to the litigious nature of this industry, exemplified by the $10 billion class action lawsuit from people alleging they got cancer from J&J's talc-based baby powder. This decision provides both entities with a more suitable framework for growth. Kenvue gains the flexibility to tailor its business models and supply chains for the brand-focused consumer market, while J&J can now sharpen its focus on the more lucrative pharmaceutical and medical device sectors, which require substantial investments in research and a business-to-business sales approach. In addition, this alleviates the burden of being associated with a highly litigious industry like consumer health. In the pharmaceutical space, investment in research and development remains a top priority to support long-term growth, and each big pharma concentrates on different therapeutic areas. In particular, J&J is reducing its focus on infectious diseases, especially following the disappointing rollout of its Janssen COVID-19 vaccine, and focusing on two therapeutic areas: oncology, which deals with cancer research and treatment, and immunology, centered around the immune system. Within the immunology portfolio, J&J has been actively developing treatments for arthritis and a monoclonal antibody it purchased as part of a $6.5 billion acquisition of Momenta in 2020. In the cancer field, the company has been successful with treatments for multiple myeloma and early-stage prostate cancer, and has entered into a worldwide partnership with Chinese biotech Cellular Biomedicine Group to develop the next-generation therapies for large B-cell lymphoma. Also, given the development of drug discovery can be risky for its business now that it does not have a cash-generating business like the consumer division, J&J is banking on the expansion of its medtech presence, which already holds a diversified portfolio across orthopedics, surgery, and electrophysiology. In particular, J&J is expanding in the cardiovascular field, as heart disease has long stood as the #1 cause of death among Americans. In 2022, the pharma giant invested more than $16 billion to buy Abiomed, a company which makes a heart pump used by patients with severe coronary artery disease. And J&J continues to seek acquisition opportunities to further grow its devices portfolio in the cardiovascular, vision, surgery, and orthopedics areas. J&J's spinoff has evoked popularity of its stock among investors. While bulls are content with the new structure and see potential on the company's latest bets, many are still worried about the loss of exclusivity on its blockbuster drugs. Industry analysts highlight J&J's strong business model following the Kenvue spinoff. The newly formed structure is poised to attract financing from more aggressive investors looking at growth rather than the stability of consumer staples corporations. In addition, the company is now better positioned to handle a recession, as people still require medical care when they are sick or have health problems. Thus, demand for pharmaceuticals and medical tech is not dependent on economic growth. However, bear analysts remain skeptical about J&J's growth prospects now that it doesn't have the deep financial pockets that the consumer health division used to bring. J&J is continuously dealing with pressures from patent expirations, meaning J&J will come under pressure if its clinical research efforts fail to progress. Once a leading healthcare conglomerate, J&J has restructured its business model to focus on the riskier, albeit more profitable, pharmaceutical and medical devices segments. Will the streamlined structure allow J&J to keep the pace of its research and development operations? Or will it succumb to competitors once patents expire? This was Stocks Explained. What company should we analyze next? Please let us know in the comments, like, and subscribe.